has been fun, actually, this year for a while, and you're at the epicenter of one of the hottest markets, of course, private credit. I don't think people realize how fast you've grown in such a short amount of time even, and even bigger goals ahead. Yeah. Let's start with the environment. This higher interest rate environment on the precipice of maybe a rate cut this year, how it impacts the way that you're thinking about investing.
Yeah, I think one of the reasons why people are drawn to private credit, aside from the fact that it's had durable performance for a very long time and it's a growing market, is most private credit instruments are floating rate. So almost perversely, the higher rates go and the longer they stay high, the better the return performance, right? So clearly a lot of capital is being just drawn to the IRR opportunity. On the flip side, as rates stay high, it contracts the deal environment. And so there's always this tension or balance between wanting to see the deal machine turn on to drive velocity of capital versus benefiting from high rates. And we're kind of getting to a sweet spot right now. I think now that rates have stabilized and that cuts are on the horizon, we are seeing the pipeline pick up meaningfully, which means you should start to see more deals, more velocity, and even if the base rate comes down, it's still going to offer a pretty attractive rate.
Let's talk more about that. What was interesting is we spoke to the audience a little earlier. We put up a poll, and more than half of the audience believes that deals will meaningfully slow down. And so what are the signs of a pickup? How meaningful could that pickup be?
Well, half the people thought deals were going to slow.
Right.
Interesting. I think in the private markets, what really drives flow is the weight of capital, is the way that I think about it. I mean, most institutional equity that supports the private deal environment has a time limit on it, 3 to 5 years to invest. And obviously, you're always trying to find the right opportunity to invest where you can benefit from earnings or cash flow growth and capture multiple expansion. We're in this time now where people have been on the sidelines for quite some time. Investors are clamoring to get capital back. So that creates some tension for people to start to monetize performing companies. And as the dry powder ages, there's also a catalyst for deal opportunities. So I can only say in our pipelines, we're seeing a meaningful acceleration in deal flow. So I would actually take the other side of the
trade.
50%.
So what do you think about this condition private equity is in? There's been so much talk about this liquidity crunch investors are feeling. How much of that is being satisfied in the credit markets through kind of more esoteric financings we're seeing out there?
Yeah, it's real. I mean, this DPI issue is absolutely real. It has not resolved itself. If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle, what the prospects for your fundraising are based on returns, but everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising. And in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors. So secondaries, continuation funds, minority sales, private credit, refinancings, all of those things are on the table.
How exciting is, for you, the private equity versus private credit opportunity these days?
It's funny. I view it all as one spectrum, and I think this is why maybe private credit is growing and getting the attention that it is. Any asset that we invest in, whether it's a company or a piece of real estate, has an unlevered free cash flow associated with it. And as the markets evolve and we innovate, it's really just a question of where do you want to attach to that asset. And in most markets, at the very early stage, sports being one, as Josh and Jason were just talking about, capital structures are pretty simplistic, right? Banks equity or banks high net worth individuals. And as the markets grow and evolve, we all get quite creative and innovative of trying to figure out where we want to attach. And so, private credit, growth in private credit is in fact an extension of people's positive experience in private equity. we're able to go deeper into some of these assets at higher rates of return with more creative structures. But we have capped upside in a lot of these, right? So in some of our opportunistic credit mandates, we're actually creating debt-like instruments that have equity upside. But private equity is critically important for the investor community because it is the only place where you can go get 2 to 3 times your money. So private credit, durable, high current yield, performs through most market cycles, but at the end of the day, your return is going to be pretty range-bound, if not capped.
Now, it was interesting. A day ago, we had a boatload of debate on this stage about private credit risks, opportunities, cracks in the market. So let's hear it from you. Where do you believe cracks are, if there are any?
We're not seeing a lot of cracks. You know, I've been in the private credit market for almost 30 years, and there's a constant and consistent narrative that there's risk being taken in private credit that somehow is going to, topple the economy or create systemic issues. Back to my earlier comment, people need to appreciate most private credit instruments that we're all talking about are backed by some form of institutional equity ownership. And most private credit instruments are levered 50 to 60% of enterprise value. So if people are really anxious about losses industry-wide in private credit, you're blowing through trillions of dollars of value in the institutional private equity, real estate, and infrastructure market. So people need to zoom out and kind of understand again where these loans sit, who they're supporting, and the types of investments. That's one. Two, we have close to 4,000 middle market investments at Ares, and the credit performance has been incredibly strong. Default rates are low, interest coverage is healthy, EBITDA is growing in the low double-digit range. So yeah, we feel pretty good about it. I think it's all a little overblown, to be honest.
So another part of the market that I did not get to ask some of our guests about yesterday that you do very much operate in is real estate. Mm-hmm. How much stress is there still in that market right now?
Well, there's more stress there than there is in the corporate market, I think, for maybe obvious reasons. One, the asset class runs more leveraged, so it's a little bit more rate sensitive. Two, the maturity wall issue in real estate is probably more acute than in corporate. The reason being there are just fewer levers to pull to effectively restructure or rehabilitate a piece of real estate. So when you think about maturity wall or even modestly underperforming corporate investments, you have levers to pull both on the balance sheet and the income statement to try to grow through it. You own a building, it's leased or it's not leased, the rent covers your debt service or it doesn't, and that's basically it. So the math of the asset class clearly sets up just for more acute stress. That said, when you put office in certain markets off to the side, we are still seeing pockets of strength in multifamily and industrial, which is where we're largely invested. So I think that story will still play out, but I don't think it's going to be a big systemic story. I think it's going to be one that kind of grinds its way out over time.
Whether it's the corporate market that might look to refinance or really restructure to kind of stave off the higher interest rate environment, or if it's real estate where you're seeing private market values really start to bottom in some people's perspective, how much money do you put to work? How big of an opportunity?
Well, as a private market investor, you can't try to perfectly time markets. That's the good news and the bad news, right? You have to be directionally accurate. We get the luxury of not having to pay attention to all of the headline, and volatility that can induce. But the best time to invest, both corporate and real assets, is when you think you're coming out of a cycle. So in real estate in particular, this is a great time to be forming capital, planting seeds, because you want to get out ahead of it. And that's our experience, in multiple cycles. So, it's a pretty good deployment environment. And like I said, we are seeing the pipelines pick up, which is encouraging.
It's interesting. In addition to just deploying for your funds, we've reported here at Bloomberg that you're also considering one of the largest private asset manager deals of all time, or at least we've seen in recent years in the real estate world. What can you say about your M&A ambitions of your own?
Well, not to speak about rumors specifically, we've been quite acquisitive, as you know. So if you look at our growth, 20% of our growth over time has come from some kind of M&A. I have a very strong view that these markets will continue to consolidate. And the reason that they're going to consolidate is from the manager's perspective, there's huge benefit to scale. right? The larger we get, the more people we can have. The more people we have, the more deals we can do. The more deals we do, the more information we get. The better information we get, the better our investment performance, and then we get more AUM. And so there's this virtuous circle and cycle that scale creates in private markets, and people are beginning to see that. Investors are putting more of their dollars with fewer managers because they see that opportunity for outperformance, and they also see a huge efficiency. So most large institutional investors you talk to will tell you that they're shrinking their investor roster from, call it 100 to maybe 20 managers to try to drive efficiency and deeper partnership. And the markets are global and globalizing. So a lot of the things that we learned, let's say, over our 25 years here, we can now apply into developing markets like Europe or Asia that are earlier on in their maturity curve. So we will continue to be at the forefront on the consolidation. We want to be a consolidator, not a consolidatee. I think we have a really good track record of buying companies financially accretive, strategically accretive, and obviously driving culture, which I think is important. But we're not alone. So I would expect to see a lot of activity, particularly once you start to see rates come down and capital start to move.
Safe to say you'd be looking for large prey.
Well, it's all relative, right? So what was large 10 years ago isn't quite so large now. So, with a market cap that's $40 to $45 billion, we can actually do some pretty transformational things in large markets while making sure that we're managing the right risk.
So let's talk a little bit about another growth area for you, which is wealth. And there have been a lot of questions in this market. A lot of asset managers trying to make their private asset management business more amenable to the retail channel. How do you do that? You've seen some very high-profile examples of jitters in the markets. Starwood, for example, limiting redemptions for investors. How do you navigate an environment
it's a good question, and maybe I'll just talk philosophically, and then we can talk specifically about how you do it. I'm a big believer in the importance of democratizing access to alternatives. For decades and decades, the world of alternatives was really only available to institutions, and so yes, individuals were able to access it, but it was indirectly as a beneficiary in a pension fund. And so the opportunity for them with a sophisticated advisor and a sophisticated investment manager to get access to some of these outcomes, I think is critically important. So big believer that it needs to happen, and big believer that it will continue to grow just because I think the advisor community sees value in it. The difficulty is, which is where I think you're raising the question, is the retail investor doesn't always behave with the same level of patience and long-termism that the institutional investor does. And so a lot of these structures that we've created are designed to give adequate and appropriate liquidity, but not necessarily function with daily liquidity the way that the retail investor is used to accessing the markets. And we view that as a huge benefit, right? Because again, having managed, for example, ARCC, which is the largest traded BDC, sometimes the best time to be investing money, as we talked about coming out of a cycle, is when people are looking for liquidity. And so you're constantly going to be trying to balance your capital base and the deployment opportunity. And then lastly, I think the challenge that this market presents is in alternatives. Historically, we've invested out of drawdown funds where we can create alpha simply by not investing. So one of the ways that we outperform over time is to actually hold back, sit on cash, and then deploy when we see a better deployment opportunity. When you are managing continuously offered product, you get $1, you put $1 into the market, and that starts to function, in a way that is antithetical to the way that you generate alpha in private markets. So we've gone slowly in scaling those because we want to get the diversification that it provides. We want to provide the outcomes to the investor, but we don't want to inherit that, the weight of the money coming in when we don't think it's right to deploy. That said, we're one of the top fundraisers and managers in the space because most of the large wirehouse platforms, RIAs, and IBDs want access to top quality alternative product. We have a wealth distribution capability with about 150 people around the globe. We have 8 products in the channel, all of which are scaling quite nicely. And so now, similar to an institutional investor, a retail investor can largely access our real estate, private equity, private credit, and infrastructure capability in some format in the non-traded market as well.
We are going to switch to sports, too.
Okay.
Because that's the fun stuff. It's also the place we're getting a lot of questions from the audience as well. And, of course, that's both through Aries' own involvement. And, of course, you are a part owner of the Baltimore Orioles. And so if you think about sports, how much investor interest can you draw? You know, we have reported that you are one of the firms close to the NFL process as well. What does this mean for the amount of money that can come into different leagues?
Well, I hinted at it earlier, so maybe I'll repeat it. That this is a new asset class, right? So if you think about the structure of the sports landscape, just teams and leagues, putting aside stadium redevelopment projects and media rights securitizations and youth sports and all the things that, right? So this is a huge ecosystem of assets. But if you just go to the team and league level, up until COVID, the structure of the market was pretty simplistic. It was bank capital and rich people. And those two sources of capital were able to support a pretty compelling, growth in value in these assets for a very long time. When COVID hit, two things happened. Number one, you had a lot of owners of teams that had generational wealth that got created through the ownership that were asset rich and cash poor, and all of a sudden had a business model where they were struggling to actually support the asset. So that caused a lot of the team owners and leagues to start thinking about the importance of some other form of creative capital to come into the market. And that really is when we leaned in at Aries to start building in earnest what is now a pretty large sports investment franchise. And then the second thing is, coming out of COVID, I think everybody relearned how important live content is and how much we all enjoy going to sporting events and how much time we spend watching on TV. And so you saw this reacceleration in the value of global media rights for sports teams and sports leagues, which started to accelerate values again. So now you had a secondary problem, which was, now that we've kind of healed through COVID, in a world where you're trying to grow your franchise value 10 to 15% per year compounding, how do I support that? There's just not enough bank capital or high net worth individuals that love sport that can actually drive those values. So a lot of the leagues and teams are now starting to think about institutional capital as a critical component of, the growth in these franchises. If you just think about you mentioned the NFL, and not to hone in on that, but if you just take the equity value of the teams in those leagues, you're talking tens and tens of billions of dollars of investable opportunity that didn't exist before.
What's the NFL math?
Well, take your number of teams and multiply it by 5. So there's $100+ billion of franchise value that needs to get supported by some form of institutional capital over time. Baseball, you have 30 teams with probably an average franchise value, in the mid-2s. So that's $70 billion of asset value, and so on and so forth. And so each league is going to be different in terms of where they are in their media positioning, what kind of flexibility they're willing to accept or not accept. But institutional capital is going to be a critical component in continuing to evolve the.
You think about the Mark Lazar comment last year about the NBA. Valuations feel toppy, so I'm getting into pickleball instead. How do you feel about that? Are valuations getting toppy? Do you look for places where maybe there's more of a runway, like women's sports?
Well, we've been a big supporter of women's sports. We helped to launch a professional women's volleyball league through our sports franchise. We've been supporting the growth in women's soccer. I don't think you have to choose one. I don't think that valuations are getting toppy. The reason that folks are drawn to investing, at least in the large leagues, is scarcity value. There's a complete lack of correlation from anything else that you can invest in. So you can go back 15, 20 years and map the growth in sports franchise values against traded fixed income, public equities, private equity. Zero correlation for the most part. So that's of significant value. So I don't think you have to choose. The upstart leagues or the challenger leagues or some of the things like youth sports, women's sports, pickleball, cornhole. There's an endless set of things that you can invest in, and they all have value, right? Like in anything we do, they're going to be on a different growth trajectory with a different set of risks and a different set of opportunities. But I think it's all getting to the same point, which is we spend a lot of time globally consuming sports content, whether it's pickleball or the NFL. Like, that is a big part of the human experience. We all emotionally attach to it. Most people are passionate about some part of the sports ecosystem, and now the opportunity to actually tap into that through investment is going to be another, accelerant, just because people want to be a part of it.